Hello, folks. Today, we, the analysts listed on this slide, would like to introduce you to the Shaw Group, a Baton Rouge-based engineering, procurement, and construction company. While Shaw could best be characterized as an EPC, the company also maintains a strong presence in power and plant services. The firm was founded by Jim Bernhardt in 1986 under the name National Fabricators. He's still the CEO. Since that time, Shaw has experienced solid growth, fueled mainly by acquisitions. In today's presentation, we're going to start by going over some quick facts, follow that with Shaw's price history, spend the bulk of our time discussing Shaw's operating segments, go over our valuation of the company, and finish by telling you what to look for in fiscal year 2012. Let's begin. Shaw's current share price is $23.84, and the company has a market capitalization of roughly $1.7 billion. As you can see from the graph, Shaw's price has been volatile over the 52-week period prior to our report date of the 29th of November 2011. From a high of $41.05 at the beginning of March, the price fell to less than half of that value, $19.66, by the middle of October. However, since the release of Shaw's fourth quarter results, the price of the stock has risen about 20% and has been hovering between $24 and $25. We believe that the steep drop in Shaw's stock price earlier in the 52-week period is a reflection of investor sentiments as they reacted to Shaw's lower than expected revenue in fiscal year 2011. Shaw, which is heavily vested in the future of nuclear power, also saw its share price decline sharply in the aftermath of the Fukushima nuclear reactor disaster in March 2011. The subsequent partial restoration of the stock price since the end of October reflects some renewed investor confidence in Shaw's future as it seeks to divest the energy and chemicals segment and its investment in Westinghouse that account for much of Shaw's losses for the last 4 quarters. Shaw is also completing a share buyback program, which is designed to increase the company's stock price in the short term. Moving on, let's look at how Shaw organizes itself. Shaw divides itself into 6 operating segments, which I will develop further in a moment. Shaw's biggest operating segment is power, which represents 36% of total revenues. In other words, building nuclear power plants. During fiscal year 2011, revenues in the power segment decreased from $2.3 billion to $2.1 billion, a decline of 8%. However, several new contracts for Chinese nuclear power reactors helped offset a larger segment decrease. We forecast slow growth in this segment as doubts over the future of nuclear energy and a slow macroeconomy cloud progress. The plant services segment, which represents 16% of total revenues, is in charge of maintaining, upgrading, and decommissioning power plants. Shaw operates 41 of the 104 reactors in the U.S. nuclear fleet. In fiscal year 2011, plant services revenues increased from $881 million to $925 million, a 5% growth rate, making this Shaw's only segment with increasing revenues. We forecast steady growth as this is a stable segment that requires action even despite gloomy macroeconomic prospects. Shaw started out as a pipe fabricator, and this is still very much a core competency for the company, although it only represents 7% of total revenues. In fiscal year 2011, revenues decreased from $492 to $408 million, a 17% decline. However, backlog increased by 20%. We forecast that Shaw's new modular assembly facility in Louisiana and its new pipe fabrication facility, currently in the final stages of construction in the United Arab Emirates, will provide new sources of revenue. However, since our regressions have shown that Shaw's revenues in this segment have historically greatly depended on American GDP, which seems laggardly, we are not expecting great things from this segment in the near term. The energy and chemicals segment, which represents 10% of revenues, provides a variety of services to the upstream and downstream oil and gas industry. From a high of $1.37 billion in fiscal year 2009, revenues in this segment have declined to $593 million in fiscal year 2011, a 46% decline in fiscal year 2011 alone. The company has cited cost overruns on large projects as well as decreasing contract opportunities as reasons for the segment's losses. As a result of poor performance, Shaw's management is planning to divest the energy and chemicals segment in the first quarter of fiscal year 2012. We agree that this appears to be the best course of action. This is the segment with 32% of revenues in charge of environmental remediation, construction management, and emergency support to clients around the world. Shaw does everything from cleaning up at Fukushima to restoring the coast of Louisiana to decommissioning military bases. Revenue in fiscal year 2011 went down from $2.2 billion to $1.9 billion, 14% decline. This decrease is likely due to the company's completion of projects in Louisiana related to Hurricanes Katrina and Rita and the Gulfwater Horizon oil spill cleanup in fiscal year 2010. However, we believe that the E&I segment is a slow-growing but steady source of revenue for Shaw. In 2006, Shaw bought a 20% stake in Westinghouse, entering into a put option agreement to sell all or part of its stake to Toshiba for 97% of the original Japanese yen equivalent purchase price of approximately $124.7 billion. Shaw issued bonds to pay for its debt, but the rapid appreciation of the Japanese yen has negatively impacted the investment as the company has incurred significant non-operating foreign exchange losses. In September 2011, Shaw sought the consent of the trustee acting on behalf of the bondholders to exercise the put option before its October 2012 expiration date. Whether it happens then or not, however, this divestiture will unwind no later than March 2013. When it came to valuating Shaw, we had to rule out using the dividend discount method because it doesn't work for companies that don't pay out dividends, the relative valuation method because it was difficult to find similar companies to compare Shaw to, and the PEG valuation method because the company had negative earnings for fiscal year 2011. When we used the discounted cash flow valuation method, we arrived at our 12-month target price of $31.82 per share. Fiscal year 2012 promises to be an important year for Shaw, and there are several key events that investors should watch out for during the coming months. First, Shaw is planning 2 segment divestitures during fiscal year 2012. Shaw's announced that it has hopes to divest its energy and chemicals segment during the first quarter of 2012. Though management has said that it does have a buyer in mind, who that buyer is or how much the bid will be for is unclear. Wary investors may be waiting to see what happens here before investing in Shaw. Shaw is currently waiting for approval from its bondholders to complete the Westinghouse divestiture. Once complete, Shaw will have no long-term debt and will no longer have large balance sheet and income statement fluctuations due to the Japanese yen-US dollar exchange rate. We feel that Shaw's recent stock price fluctuations have in part been due to confusion surrounding the Westinghouse segment. Once the segment is divested, we may see Shaw's stock price volatility decline. We also feel that getting approval from the Nuclear Regulatory Commission for the AP1000 nuclear reactor design and site permits will be an important benchmark for Shaw. The NRC is slated to make its decision on the permits in January 2012. Shaw's been waiting for these permits for several years and has a handful of AP1000 projects that it can add to its power segment backlog if these permits come through. Shaw's management feels that these permits are a sure thing and once granted will produce a, quote, party on Wall Street, end quote. We don't disagree, but are concerned about the future of the power segment if these permits are further delayed or denied. Finally, Shaw has announced that it is actively seeking acquisition opportunities and has hinted that it plans to pursue opportunities outside of the nuclear industry. Shaw's management team has a history of making prescient acquisitions that lead to highly profitable business segments. We look forward to hearing more information from management on how its acquisition search is proceeding and whether it has a target company in mind. We would like to express our sincere gratitude for your taking the time to watch our video. Our analysts were Rob Berryman, Yanan Fang, Megan Greeley, Daniel Korda, and Natalie Jordy. If you have any questions or comments for us, please don't hesitate to send us an email.